Last episode, I showed you the machine that billionaires use. Today, I'm going to show you a very similar machine, except it's kind of been sitting quietly for the average person, and the IRS is practically just begging you to use it. Most people view their home as a place to live. Almost no one sees it as a tax advantage appreciating asset that it actually can be. US real estate isn't just built for the wealthy. The tax code wrote the same playbook into the real estate system for normal people, but with 5 bonuses that sometimes, quite honestly, billionaires can't even get. Ownership isn't reserved for the rich. You probably already own or are working towards it. The question is whether you're using the asset, understanding it, or you're just kind of living in it. By the end of this episode, I'm going to give you 5 levers that most homeowners don't think about when they are looking to buy. Some they take advantage of, and some they just don't. Welcome to the Net Wealth Nest podcast. Okay, so let's kind of talk through it. Buy. We want to buy an appreciating asset. Bezos, he got those Amazon shares. You, on the other hand, can buy a house. Both are assets that grow tax deferred while you hold them. US real estate has averaged 3 to 4% annual appreciation long term or historically. Sounds boring next to stocks. That's until you add leverage to the math. And here is the math. 50K down on a $250,000 house, maybe that house goes up 5%. That's $12,500 increase. That's 25% return on your cash. Try that with a stock portfolio. Borrow. You can actually borrow against equity without selling. Things like a HELOC, a cash out refinance, second mortgage. You can pull equity out of there without ever triggering capital gains. Remember, loan money is not income. Same tax-free treatment as the billionaires use with the SBLOC. Different name, same kind of principle. Now, don't get too aggressive here. We will talk about when this makes sense and when it doesn't in just a few minutes. And the last thing, the die part. Step-up basis applies in real estate the same way it applies to stocks. Heirs inherit a current market value, a lifetime of appreciation erased for tax purposes. The same federal rule that hands $1 billion break to Bezos' kids hands a real break to yours. Quick pause for a second. If anything I've shared so far has hit a nerve, if you're carrying debt you can't seem to shake, or if you haven't started investing yet, or you're just not sure where you actually stand financially, I built something specifically for that. It's called the Financial Pulse Check. It's 2 minutes, 7 questions, and it'll tell you exactly which money habit is costing you the most right now and what to do about it first. It's free. It's at netwealthnest.com/pulse. Or you could just head over to our website, netwealthnest.com, and you'll see the floating bubble. And I'll drop the link in the show notes for you too. But just take it before you forget. One more time, that's at netwealthnest.com/pulse. All right, let's keep going. Okay, so what are the 5 levers that you can do? And some of these, the ultra wealthy don't even qualify for. So the first one, most people know about, and that's capital gains exclusion. If you sell your primary residence after living there for at least 2 years, the first $250,000 if you're single, or the first $500,000 if you're married, of profit are tax-free. Bezos, when he sells his $10 million house, doesn't get this. It's uniquely yours. So let me give you an example. Let's say somebody bought a house for $250K and they sell it 20 years later, and it has appreciated to, let's just say $700,000. That's not out of the realm of possibility in the real estate market that we've seen for decades on end. That profit, about $450,000. A married couple, that means 0 federal tax. The wealthy version of this, where with stocks, you could owe $100,000 in capital gains on the same profit. Here's the cool kicker. You can do this every 2 years as long as you're living in that property for 2 years. It's your primary residence. Lever number 2, mortgage interest deduction. On up to $750,000 of mortgage debt, the interest is tax deductible on what they call Schedule A. Unlike the lines of credit that we've talked about in the past, you cannot deduct that interest. The billionaire doesn't actually get that break. But a real number here on a 7% mortgage, which is a little high right now, but let's just say 7%, $400,000 loan, that's almost $28,000 in deductible interest, worth about $6,700 to somebody who's in the 24% tax bracket. Okay, lever 3, depreciation. Now, this is just on rental properties, but the IRS pretends that your rental is wearing out over time. Most of the time it isn't, as long as you take care of it. And it lets you take that paper loss each year. So residential rentals, they depreciate the building value over 27 and a half years. So to make this math easy, let's say you bought a rental for $275,000. That's $10,000 a year in a deduction. What that means and what you typically see in rentals is profitable rentals, often they show losses on paper. The IRS is almost subsidizing your wealth building in those examples. Lever 4, another rental strategy, the 1031 exchange. Let's say you're going to sell a rental property. Instead of taking the profit and having to pay long-term gains on it, you can roll those proceeds into another investment property, as long as you do within 180 days, and defer all the capital gains. And the cool part is you could do this over and over. You can literally buy a new property and step up into bigger and better properties as you go forever. And then the cool part is if you hold on to that real estate and pass away, the step up basis erases all the deferred gains. Your heirs inherit a clean break, clean step up, whatever the value is now. It is literally the same buy, borrow, die strategy that we were just talking about with stocks, but written into the real estate. The tax code actually did the work for you. So lever number 5, great for young people. This is house hacking. You can get an FHA loan, 3.5% down on a primary residence that is up to 4 units. You could live in one of those and rent the others. Now, what do I mean by that? You could get a single family house and rent out bedrooms. You could get a duplex or a threeplex or a fourplex and actually rent out those other units to help pay for your mortgage. The tenants, they're actually helping you pay for your mortgage and they're actually helping you build equity. And the cool part is, as long as you live there, you still qualify for primary residence benefits like the mortgage deduction. This is one of the single most accessible wealth building tools in US real estate. And quite frankly, almost nobody uses it. Now, part of that reason is a lot of people, they don't like to live with other people or they want just their own property. But this is a really cool way to actually get into real estate if you can get past that part. If you can live with other individuals, or if you can find a property that you're willing to manage and screen and get tenants in, this is an incredibly powerful way to break into the real estate game at the least amount of capital that you need and taking on the most benefits when it comes to leverage and tenants paying for your mortgage. Okay, so let's talk a little bit about how people fumble this or mess this up. First mistake, they treat their house as an ATM for their lifestyle. Now, I mentioned earlier that we were going to talk about when to borrow against your home and all of that type of thing. The wealthy borrow against their home to acquire more assets, or basically using their current asset to acquire more asset. The middle class often borrows against the house for things like vacations, weddings, cars, those types of things. Now, one kind of caveat here is sometimes it does make sense when you are doing upgrades to your property. For example, if you're adding bedrooms or larger renovations where you're re-renovating and bringing everything up to date. Those types of things can make sense to increase the value of your home. Again, you're using the current asset to drive a higher asset, even if it's inside that same house. And the thing to keep in mind here is 2008, it wasn't random. You had millions of people HELOCing their lifestyle into a downturn. Just because you can borrow money against an asset doesn't mean you should. Okay, mistake number 2. Selling too soon and losing the exclusion. That 2-year rule is not really optional. You sell it year one and you lose the $250,000, or if you're married, the $500,000 break entirely. That could be a six-figure mistake. You have to stay away from that. Be sure you're going to stay in that property for at least 2 years. Mistake number 3, refinancing without actually doing the math. Closing costs now, they can run 2 to 5% of the loan. You need to stay in the loan long enough to recoup that. At today's 5, 6, 7% rates, depending on where you fall, refis, they usually don't make sense, especially for people that have been sitting on 3, 4, or 5% mortgages from 2020, 2021, or even 2022. Don't blow up a great rate by chasing a worse one. Mistake number 4, buying the dream house first. This one is really hard for people to get past. Most people, when they buy a house, they want to be excited about it. They want to feel like they're going to live in that house forever. That first home, it probably should be the most boring, most profitable thing you can buy. The ability to build equity is so important for the long term. It may allow you to buy that dream house down the road later. Here's what I'll say about this. You also should be aware of what and where you're buying. Now, I'm not saying to buy the most boring, most profitable house in a horrible neighborhood with a house that's probably falling apart and needs a ton of work. I'm not saying any of that. What I am saying is find a neighborhood you want. Maybe it's not your dream neighborhood or your dream subdivision or a gated community in some of these areas, but it's somewhere that you feel comfortable living. Or if you have a family, that you feel very comfortable with your family living. Decent schools, a good neighborhood, low crime, and things around you that you can do, great shopping opportunities, all of those things. You should look into that and have a solid neighborhood that you want to be in, because that also helps your equity long-term as that house appreciates. Good neighborhoods appreciate well. All right, last mistake that most people make, they underestimate the cost of ownership. You should be budgeting 1% of your home value per year for maintenance. That means that if you buy a $300,000 house, you should be budgeting about $3,000 a year in maintenance for that. Now, keep in mind that doesn't cover things like insurance or property taxes. The other thing you want to think about is you need enough buffer space that you could replace something big if it happened. I'm going to use roof because it's one of the most expensive items, but you could easily pay $15,000 or $20,000 for a new roof. Now, part of that is when you're buying it, making sure you understand how long your roof's going to last, and also making sure you have insurance to protect you against catastrophic failures like storm damage, tornadoes, hail, those types of things. You want to make sure that you have enough understanding of what those maintenance costs are going to run you year in and year out, so that you're not put in a situation where you're having to defer maintenance in your house, which will deteriorate your actual appreciation of the house, especially if you can't get it up to everything a new buyer would want before you go to sell. The other thing is you want to make sure that you're not house poor. Buying the maximum a bank approves kind of cancels every advantage we have in this episode. Make sure that it's an affordable payment to you, that you're calculating in those costs so that you can maintain this property and hold on to it. Again, the whole part, as long as you possibly can. Okay, so before we get into the 3 bullets to wrap it up and maybe a little bit of homework that you can do if you're trying to go down this road, one thing I want to mention, if this episode is helpful for you, make sure you're subscribing to our podcast or our YouTube channel. Also, if you haven't taken our pulse check yet, I recommend you do that. It takes you just a couple minutes to go on, and it will help you understand where you're sitting and allow you to understand what your next steps might be to break out of that paycheck to paycheck cycle. That's right at our website, netwealthnest.com, and you'll see a floating bubble right there at the top of the screen that'll allow you to access the pulse check. It's just helping you take that next step and understand what you need to do to build your financial stability. Okay, so the 3 bullets to wrap this up. Understand there are options for owning, holding, and tax advantages to the everyday person that replicate that buy, borrow, die strategy that you hear billionaires taking advantage of all the time. And owning a home, quite frankly, is one of them. Don't forget that there are those 5 levers that work for real estate, depending on if you are living in the home or if you're buying a rental property, or maybe both. Capital gains, mortgage interest deduction. You've got depreciation and 1031 exchanges on your rentals. And last but of course not least, you have your house hack. And then the third bullet, understand the mistakes that people make in this area. They don't do their homework on costs, or they move out too early, or they buy at the top of what they can afford and become house poor. That's not where you want to be. Now, as you go through this episode, there's a couple of things you can do to try to understand where you're at and maybe some next steps. If you own, pull your latest home value, Zillow or Redfin, take it with a grain of salt, maybe estimate 5 or 10% less, and then your loan balance against that. That's your equity number. Most people, they don't know what it is. If you don't, find out. If you don't own, run a quick rent versus buy in your area at today's rates. We're going to talk more about this in the next episode and how to really evaluate and take those next steps, but it's worth understanding where the math lies. And then either way, whether you already own or you're looking to own, understand that 2-year rule and the capital gains exclusion clock. It's worth knowing before you make any moves so you can just understand what those next steps are going to look like. On the next episode, we're going to go from theory and what we talked about today to exactly what to do next. A couple of different paths. If you already own, if you don't own yet, or if you're ready for your first investment property. I'm going to show you the specific moves you can make this year based on where you actually are. I hope today was helpful for you. If it was, again, leave us a review, subscribe to our podcast or our YouTube channel, and I look forward to seeing you at our next episode. For Net Wealth Nest, my name's Jim. Bye, everybody. Net Wealth Nest LLC and Podcast is an educational platform committed to providing resources and information to empower individuals on their financial journey. Please note, we do not provide financial, tax, or investment advice. All financial decisions should be made in consultation with a qualified professional who understands your unique circumstances. Seeking personalized advice is a smart and necessary step before making any major financial commitments. Thanks so much for joining us today. If you found value in this episode, please like and subscribe to our YouTube channel, Net Wealth Nest, and leave us a review on your favorite podcast platform. We read every comment, and they help us improve and guide what topics we dive into next. And hey, if something you heard today resonated with you, don't keep it to yourself. Share it with a friend, a family member, a coworker, your barber, your barista, even a stranger in line. You never know who might need this message. Remember, building net wealth is a journey, but you don't have to do it alone. Stick with us, and together, let's grow your net wealth nest.